Hey guys, welcome back to the channel. This is Stock Brock. Today I am breaking down one of my absolute favorite ways to make money and to approach options trading. For long-term investing, LEAPS. If regular options feel like a race against time, this one you'll want to know about. As always, none of this is financial advice, just sharing my favorite tools to make money and to grow my wealth. Hope that I can help you with that. So let's break it down what LEAPS are. Basically, LEAPS stands for Long-Term Equity Anticipation Securities. And the P comes from patient and anticipation. Little funky, but it works. In simple terms, they're options contracts with much longer expirations. So it's not that quick in and out trading. Even though you can make money quickly, this is more for a longer term type of play. Usually 1 to 3 years out compared to just a few weeks or weekly or months you see with standard options and higher theta, which is basically the time decay on your options. Just like regular calls and puts, they give you the right to buy or sell 100 shares at a set price, but you get a lot more time for your investment thesis to play out. For example, say if you bought at the top in March of 2020, right before COVID happened, you would have felt down in the dumps maybe a couple weeks later because we had that COVID drop and it was drastic. But if you had a leap and you waited 2 more months, like 2 more months, you would have been up 100+% with the LEAPS contract, depending on which, maybe you had an S&P or whatever stock. Most stocks were up above March level 2 to 3 months later. So it just gives you more time for your investment thesis to play out. Here's why I love LEAPS. First, because they're long-term. LEAPS are way less affected by time decay, which is theta. One of the Greeks in the options contract is basically day by day time decays at your option. But for LEAPS, it's much less affected by time decay than short-term options. That means your option loses value much more slowly as the expiration date approaches, giving you flexibility and peace of mind. Second, LEAPS can almost act like a stock replacement. Instead of buying 100 shares up front, you can use LEAPS call, which costs less capital, but still lets you benefit if the stock goes up, amplifying returns if you're right without requiring as much cash. So it gives you much more leverage without having to spend as much. And with LEAPS puts, you can hedge long run risks. So say right now you're a little worried that the stock market may drop with tariffs and all the uncertainty, possibly inflation popping back up. Those are all risks right now. Political tensions popping up, war, anything like that. You can do a LEAP option or a put option in a LEAP format. You can hedge long run risks like we have right now in a portfolio by locking in a floor price over a couple years. Great for long-term investors wary of big drops. So I'm sure there's a lot of big traders that are buying LEAPS put options right now because they may be a little concerned on the market being at all-time highs. I usually use LEAPS for 2 things: going bullish on high conviction stocks, especially like a company like Costco, in a drop. I mean, who doesn't go to Costco? Going bullish on high conviction stocks where I trust the long-term view, or protecting my portfolio with puts. But this one, with puts, I don't do it too often. I'm doing more calls on valuable companies, high value, strong balance sheet companies that your everyday company. For example, Costco. If I have a lot of stock exposure and want a safety net, I will do the put options in a LEAP format. But for example, instead of buying 100 shares of a growth stock, Sometimes I'll buy LEAPS call 1 to 2 years out. If things go my way, I capture gains with less upfront investment. If not, my risk is limited to the premium, not the entire share value. LEAPS aren't magic. They do cost more than regular options, and not with every stock offers LEAPS contracts. Plus, you'll still face risk from volatility and need to stick with the thesis for a long period of time. So they're really expensive, and they are still risky because it could go against you really fast and it could make you a little nervous. But if you stick to your thesis and average down, who knows? But that's why I stick with the high value companies, because it's going to be hard to take out a company like Costco, but they are very expensive. So that is the downfall to LEAPS. But it's easy to get shaken out of your stock swings wildly. But for me, they offer the best blend of flexibility and capital efficiency and downside control over long periods. I hope this video helped why I like LEAPS and why you could potentially use LEAPS in the future. They are my go-to big picture options play. Drop a comment below if you like this video. My name is Stock Brock, and peace out.